Opinion coming in on the crude oil prices currently around $88 a barrel. But the other commodity that we're looking at today is the entire metals pack. Actually, metal prices are under pressure. So Manisha is here to tell us why and to fill us in with all of the details. Manisha.
Well, thank you for that. Yesterday was a different day. We saw almost all commodities actually gain up on back of the safe haven. And what could this really mean going forward? At this point in time, we do understand that there is no real impact on ground in supply of many of these metals. In any case, we've been struggling with demand for some time now. The inventories have been increasing as well for many of these metal prices. So when you look at a week-on-week basis, we still are trading in the negative for many of these metal prices. So whether it's copper, zinc, lead, aluminum, all of that has been under pressure. And lately, there has been a report from International Study Group on lead and zinc, and I'll start with lead first, where we are looking at higher lead production coming in from countries like Australia, China and India, and that's weighing onto the markets. The International Study Group actually has put out numbers for this year and the next as well. For this year, they're anticipating that you could be looking at 35,000 tons of surplus lead into the markets, and next year it could increase to 52,000 tons as well. While the demand numbers are also increasing, but the supply is definitely on the much higher side here. For zinc as well, for this year, the expectation are that we are staring at 248,000 tons of extra refined zinc in the global markets. And next year, this could increase to 367,000 tons of extra zinc. Markets are not looking at very strong demand coming in from China. The production here in case also has been increasing in Europe and China itself. But until the time the demand does not pick up or we see macros changing up, the pressure on metal prices is pretty much expected to continue.
Okay, thank you very much for that. We'll slip into a very short break on that.